Welcome to Electrified. It's your host, Dylan Loomis. Quick shout out to my newest patron, Amaris L. Thank you for choosing to support the channel. First up today, talking about Tesla buying back some stock, and it all originated from this tweet from Koguan Leo, one of Tesla's largest shareholders. Tesla must announce immediately and buy back 5 billion of Tesla shares from its free cash flow this year and 10 billion from its FCF next year, without affecting its existing $18 billion in cash reserves, also with zero debt. So yes, this would actually be possible, but just because Tesla can, does that also mean that they should? That's what we're going to talk about today. And if you're wondering how is this possible, well, if everything goes according to plan, Tesla should make more than $5 billion in free cash flow this year and more than 10 billion next year. And remember, free cash flow is after all expenses for expanding the business. So free cash flow is what you have left after all CapEx, capital expenditures, R&D, all expansion, all of that is already paid for. Free cash flow is then what you have left after that. And Gary Black says Tesla's institutional shareholders would likely give management a grade of C or D when it comes to capital allocation. Institutions have complained about the Bitcoin purchase and letting cash build on the balance sheet at less than 1% return for 12 to 18 months. A share buyback of $5 to $10 billion per year makes sense with $18 billion cash and no debt. Before I explain this, I know that this is a polarizing topic. Some people are strongly on one side and some are strongly on the other. So with this video, I want to lay out some thinking points just to put it out there. And then toward the end, I will share which way I personally would lean given Tesla's current position. After corporate tax cuts in 2017, paired with low interest rates and relatively high earnings, this led to massive corporate cash stockpiles, giving companies options to buy other companies, more research and development, buy new equipment, build new factories, or they could return that money to shareholders via stock buybacks. Keep in mind, when corporations do this, the number of shares outstanding decreases, resulting in a positive impact to earnings per share figures, as the denominator is now lower. Not only that, but the remaining shareholders will own a slightly larger portion of the company since there are less pieces of the pie now available. Share buybacks can also be superior to dividends, even though they are very similar. Dividends are taxed twice, once at the corporate level when the money is earned, and then at the investor level when the dividend is received. Buybacks, on the other hand, avoid this second level of taxation. So yes, in the short term, many investors love this idea, but so does management, as higher earnings oftentimes mean higher stock prices, making their stock options more valuable. And then there's the question of growth. Sure, if a company isn't confident in future demand for a product or a service, then it would be wise to consider buybacks with that extra cash rather than building a new factory or hiring more employees. But what about a company that's perceived to have overwhelming demand? Should any amount of money really be given back to the shareholders rather than spending that more to meet that unfilled demand? Then there's the question and the debate around the stock price. What if it is undervalued? When stock prices are depressed, that allows the capital a corporation uses on buybacks to go much further, buying back more shares. And listen to this, over the past decade, S&P companies have spent $5.3 trillion into stock buybacks, which has been a force in that decade-long bull market. So why might this be a problem? It's simple, really. That's $5.3 trillion not going into hiring, expanding manufacturing, more research and development. And that will ultimately matter to some degree this coming decade. But remember, some companies can do these buybacks and still grow, while others are choosing to do buybacks to artificially boost EPS figures for corporate bonuses that don't actually have the free cash flow to be doing so in the first place. So what about Tesla specifically? Well, Tesla generated $2.8 billion in free cash flow in 2020 and $5 billion in 2021, which gives Tesla a free cash flow growth of 80% year over year from 21 over 2020. Let's say Tesla grows this figure at 60% in 2022, given the China issues, 2 new factories ramping. This means Tesla would generate $8 billion in free cash flow for 2022. And Tesla currently has $17.5 billion in cash. And as I said, free cash flow is the remaining cash available after all capital expenditures, meaning money left over after spending money to grow the company. Elon has said that Tesla is spending money as fast as it can without being reckless. So could Tesla afford a $5 billion buyback this year and a $10 billion buyback next year? The answer is yes, but remember, just because you can doesn't mean you should. It's very important to remember though that nothing in the market is ever certain. Even though we all believe Tesla's cash flow will continue to grow and expand, in the short term, it will be depressed in Q2 given the issues we mentioned before, and there are no guarantees as this free cash flow for this year and next year has not yet been earned. Tesla still has to execute and the economy is still very uncertain. If the economy continues to worsen, it's obviously wise for Tesla to maintain a strong cash balance to give it flexibility and to allow Tesla to avoid being forced into a situation where it has to raise money with debt in the future, especially in a rising rate environment. And remember, they also have a junk bond rating. Just because Tesla is not spending its cash right now does not mean it doesn't have plans to do so in the future. Is Tesla considering buying a mining company? Would they ever build a chip fab? Are they going to start mining on their own? Any of these could easily require $10 billion plus, and I think Tesla wants the optionality and the freedom from raising debt and protection in a bear market more than it would want to inflate EPS figures or to boost the stock price in the near term. Lower stock prices also mean employees can afford more in the employee stock purchase program, benefiting them in the long run. And before I give what my preference would be, let me remind us all that to think that any of us, Gary, Rob, Koguan, Dave, anybody, that any of us know better than Tesla's finance team is honestly laughable. They obviously know buybacks are an option, and if they thought it was the best move, they will do it. We have a fraction of the data that Tesla is working with, so to suggest that because one of Tesla's biggest shareholders or a fund manager with an incentive for Tesla's stock price to do well, because they're clamoring for a buyback, that does not mean it's the best decision. No disrespect to them at all, I respect them both greatly. I'm just saying there is so much uncertainty in the world right now, such limited data we're working with, and so much opportunity of future growth for Tesla that spending $15 billion over the next 2 years on a share buyback seems suboptimal. All that said, it could be a strong signal to the market and to cater to that cohort that would love a buyback. The share price is depressed right now. Tesla really is a free cash flow generating machine. It's already spending and expanding about as quickly as they can, at least according to Elon. So I personally would not want Tesla to go as big as 5 or 10 billion, but maybe 2 billion this year and 4 billion next year if things go well and free cash flow keeps expanding, and pair that with a stock split and we'll all be sitting pretty. So now I'm curious, what do you guys think? Buyback, yes or no? And if yes, how much? Moving on, Dan Ives has cut his Tesla price target from 1,400 down to 1,000, saying the success of the China story on both the supply and demand side are the linchpins to our long-term bull thesis in Tesla. That said, the reality is the current Shanghai lockdowns have been an epic disaster so far in the June quarter, and we expect Tesla to see modest delivery softness this quarter with a slower growth trajectory in the key China region into the second half of the year. So I agree with part of this in that I do think Q2 is going to be somewhat jarring for many Tesla investors that are just getting used to Tesla doing amazing numbers every quarter. With that said, I'm thinking that once we get to July and the beginning of the third quarter, that if COVID cooperates in China, which yes is a big if, and these suppliers can get back up and running, I do think Giga Shanghai has the ability to ramp back up faster than many people, especially Wall Street analysts, would expect. And I would also disagree with the fact that China is a linchpin to a long-term bull thesis for Tesla. For me, it would be 4680s and autonomy when we're talking long-term. We got the FSD Beta 10.12 release notes, and they are very long as Elon said that they would be, but with the help of some experts, I'm going to try to provide a summary of what they're saying. And before we get into it, as you can see, some of the visualizations have improved, and many people out there were looking at this image thinking that it's now predicting which way other cars are going to be going, looking at these lines right here. However, if you look at the left lane over here, there's no car there and it's predicting this turn. So it might just be where the lanes are going, not where other cars are going. And it's also important to remember that most of what the beta sees is not yet modeled on the user interface, and that Tesla does plan to add more of this with time. So here's a summary of the release notes. Shout out to Asimo. Cars can now use medians for difficult left turns and accelerate quicker to actually complete these turns. Cars now have a better idea of objects blocking camera views, meaning creeping should be less intimidating. There will be improved path predictions of where other cars on the road will be, giving FSD better decision making for turns. Thanks to a lot of new data, FSD should better see the lanes on the road and how many of them there are, since FSD is now trained on 180,000 new clips related to what lanes look like. Road edges and road lines are now more accurate, and FSD better understands visibility from the cameras thanks to 30,000 new video clips of training data. The traveling speed of motorcycles, pedestrians, and cyclists is now more accurate, and FSD is less likely to confuse a parked car and an idling car thanks to 41,000 new clips of training data. And yes, this should result in fewer phantom braking instances. There will be new 3D models for vehicles on the screen, and Tesla retired a few old systems and gained 2 frames per second per camera, resulting in better performance. And while 2 frames per second may not sound like a lot, it is per camera, of which there are 8, and this was done by removing 3 legacy neural nets, which is a step in the right direction toward that single stack architecture that we might or will hopefully see on V11. In case you're getting this error, the solution for now due to a software update is going to be unplugging and plugging back in the USB. You might have to do it every time you get in the car, but Tesla service is aware of it and they are working on a fix. The Tesla Semi was spotted in Fremont, as is this Hyundai in the background with this massive LiDAR on the roof. And Honda released this teaser of its upcoming Prologue, set to go on sale in 2024, and this is a joint venture with, you guessed it, GM, using their Ultium battery technology, with Honda designing the exterior and the interior. That'll do it for today. Please take a second to like the video if you did. Hope you guys have a wonderful day, and a huge thank you to all of my Patreon supporters.